Finra rules require that advertisements include information about the securities that are offered by companies. Communications cannot be misleading. Advertisements must be approved by a registered principal prior to use. An advertisement can offer something for free when there are no strings attached. Historical illustrations based on factual performance are allowed. A research report that indicates a stock is a buy would be allowable. A product illustration that highlights how investments are different would be okay. Using the past to predict the future in a communication with the public is always prohibited. There are 3 categories of communication with the public under Finra rules: retail communications, correspondence, and institutional communications. Finra rules define a retail communication as a written communication, including electronic, distributed or made available to more than 25 retail investors within any 30 calendar day period. A retail investor includes any person other than an institutional investor, regardless of whether or not they are a current, former, or prospective customer of the firm. Retail communications require principal pre-approval prior to use or its filing with Finra. Compliance responsibilities are the same for the broker-dealer, whether communicating via the internet or other electronic media or in person. Prospectuses and offering circulars are not considered communications regulated under Finra rules. They are regulated by federal securities laws. Websites are included within the definition of retail communications. Institutional communications are written communications made available to institutional clients. Institutional communications do not require principal pre-approval, but the firm must have procedures to educate and train their associated persons the rules related to institutional communications. An institutional communication will be treated as a retail communication anytime the member has reason to believe that the communication may be made available to any investor that is not institutional. Finra rules define a correspondence as any written communication, including electronic, distributed or made available to 25 or fewer retail investors within any 30 calendar day period. Correspondence is not subject to the principal pre-approval rule, but may be subject to principal pre- or post-review. The firm must have written procedures to review incoming and outgoing correspondences with the public. When a member firm is new, for the first year of business from registration with Finra, they must file all retail communications with Finra at least 10 business days prior to first use. After a firm has been in business for 1 year, they are considered an established firm and are then required to file retail communications with Finra within 10 business days of first use. Finra's name rule requires that any time a fund name has a type of security listed in it, the fund must invest at least 80% of its assets in the described investment. Generic advertisements can never include the name of any specific security. When advertising total return for a fund, the fund must include total return for 1, 5, and 10-year periods or since inception if shorter than 10 years. When a municipal bond fund advertises using tax equivalent yield, it must also include current yield and total return. None of the yields can be shown in greater prominence than any other. A research report is written by an analyst focusing on either a particular company or sector of the economy and often, but not always, includes a recommendation to buy, sell, or hold. Research reports approval depends upon if it is used as a retail communication, institutional communication, or correspondence. When a research report is used like a retail communication, principal pre-approval is required. To qualify as an independently prepared reprint, the publisher must not be an affiliate of the member using the reprint or any underwriter or issuer of the security mentioned in the reprint. Neither the member using the reprint nor the underwriter nor the issuer may have commissioned the reprinted article. All independently prepared reprints must be pre-approved by a principal and are exempt from filing with Finra. Any time an associated person makes a recommendation during a public appearance, any personal financial interest in the security must be disclosed. Finra rules specifically prohibit describing volatility as a risk rating. Finra rules define a bond's mutual fund volatility rating as a measurement of the sensitivity of the net asset value of a bond portfolio related to changes in market conditions and the general economy. When an investment company uses a ranking that is their creation or that is not generally published, the retail communication must be filed with Finra at least 10 business days before first use. If, in fact, an investment company has been ranked number 1 in a specific category, the investment company is allowed to use this in their advertisements so long as Finra rules are followed. Retail communications and independently prepared reprints must be kept for 3 years from the date of last use. Records must include the name of the principal who pre-approved their use. When using a statistical table, chart, graph, or illustration in a communication, information concerning the source of the data must be kept as part of the records. Communications related to variable contracts must never refer to these investments as being liquid or short-term. In a variable contract communication, there can be no guarantees as to rate of return. The separate account cannot be referred to as a mutual fund in any communication. Variable contract advertisements can include hypothetical rates of return up to 12%, so long as a 0% rate of return is also used. An investor who makes a purchase based upon a prospectus that includes false statements may sue the following parties to recover civil liabilities: those who sign the registration statement, directors and officers of the issuer, anyone named in the registration statement as about to become a director, anyone who contributed to the registration statement, and/or the underwriters. Any client with a cash or securities position at a brokerage firm, regardless of how recent the activity, must be sent an account statement quarterly. When a broker-dealer sells securities in a retail banking establishment, the securities business must take place in an area separate from where the retail deposits are taken. When a broker-dealer does business in the premises of a bank, the broker-dealer's name must be clearly displayed. When a broker-dealer does business in the premises of a bank at or prior to the opening of the securities account, there are disclosures that must be made both in writing and verbally. These disclosures include the fact that the securities being purchased are not insured by the FDIC, are not deposits of the bank, and are subject to investment risks, including the possible loss of the principal invested. A summary prospectus includes key information from the statutory prospectus. Investors may purchase shares from the summary prospectus application, or they may request a statutory prospectus. A statement of additional information, SAI, must be provided to an investor upon request with no charge. Finra Rule 3230 is the telemarketing rule. It allows for solicitation calls to be made to prospective clients from 8 a.m. to 9 p.m. of the time zone in which the person being called lives. Telemarketing rules allow for an associated person to call a person with whom they have a personal relationship at any time. Telemarketing rules allow for a registered representative to call a client who is on the do not call list, because the telemarketing rules do not apply to people that the firm has an established business relationship with. When a client of a firm requests to be put on the firm's do not call list, the firm may no longer solicit the client via telephone. Calling a referral from a customer before 8 a.m. would be a violation of the telephone solicitation regulations. When a firm has been advised by Finra that it must tape record all conversations, they have 60 days to implement the requirement. A firm that is subject to Finra's taping rule must record all telephone conversations with both new and prospective clients for 3 years. A firm that has been notified by Finra that they are subject to the taping rule is allowed a one-time opportunity to reduce its staffing levels to below the threshold limits within 30 days of receiving written notice. Investment bankers are broker-dealers who specialize in taking companies public. They are often called underwriters. Underwriters help the issuer file the registration statement with the SEC as required under the Securities Act of 1933. The investment banking firm's syndicate desk builds the order book and allocates the issue. It is the responsibility of the syndicate member firms involved in underwriting the new issue to perform due diligence, ensuring that the information presented in the registration statement and prospectus is accurate. In an initial public offering, syndicate member firms are bound by the underwriting agreement. In a best efforts underwriting agreement, the firm agrees to sell as many shares as it can, but is under no obligation. Standby underwriters are used during a rights offering. In an all or none underwriting, if the syndicate is not able to sell all of the shares, they will sell none of them. In a mini-max underwriting, if the minimum number of shares are sold, the syndicate will continue selling shares. If the minimum is not met, the offering is canceled. In a firm commitment underwriting agreement, the syndicate agrees to buy all of the shares of the initial public offering from the issuer, then must sell those shares to the general public in order to make money. Firm commitments are the most common type of underwriting agreement. Firm commitment underwritings have the most risk for the syndicate member firms. Selling group members are often small local broker-dealers that are not bound by the underwriting agreement. Selling group members are purely best efforts. A syndicate member firm would give up their shares to the selling group member. The selling group member gets paid a concession. In a public offering, a registration statement must be filed with the SEC, and the SEC must clear the issue prior to sale. In a private securities offering, there is no requirement to file a registration statement since the securities are not being offered to the public, but instead are only being offered to certain types of investors. In an initial public offering, new shares are sold by the issuer to the general public to raise capital for the issuer. New shares trade one time in the primary market. A primary market transaction is also called an issuer transaction since the money raised goes to the issuer. In a secondary offering, existing shareholders are selling shares. A follow-on offering is when a corporation offers shares to the public after an IPO. In a dilutive follow-on offering, the issuer is selling new shares, causing the earnings per share to decrease. In a non-dilutive offering, the shares being offered to the public are not new shares, but shares that were already issued, often held by insiders and control persons. A non-dilutive follow-on offering does not reduce earnings per share. A non-dilutive follow-on offering is also called a secondary offering. When an issuer files a registration statement with the SEC, the minimum 20-day cooling-off period begins. The cooling-off period may be longer than 20 days. During the cooling off period, the SEC is reviewing the registration statement for complete information, but not for accuracy of the information. The responsibility of due diligence falls to the issuer and the underwriter. During the cooling off period, there can be no solicitations made, but indications of interest may be taken so long as they are non-binding. Distributing the final prospectus, disseminating advertising materials and/or sales literature, taking orders, and accepting post-dated checks are all prohibited until the issue has been cleared by the SEC for sale. A red herring is a preliminary prospectus that may be given to investors during the cooling off period. A tombstone announcing the issue can be placed during the cooling off period. A prospectus, which summarizes the SEC registration statement, must be delivered to purchasers of new stock in the primary market prior to or at the time of sale. The SEC never approves or disapproves any securities offering. The SEC disclaimer must appear on the front of every final prospectus. When a new issue is not registered with the SEC because it is an exempt security, the paperwork given to a prospective purchaser is called an offering circular or official statement. In a shelf registration, securities can be sold off the shelf for 2 years from the time the issue is cleared for sale by the SEC. There are 2 types of municipal bidding processes: competitive and negotiated. In the competitive bidding process, the notice of sale is used to solicit bids. The official notice of sale is placed in the daily bond buyer. With municipal issues, the most common type of underwriting contract is a competitive bid firm commitment, with the lowest costs winning the contract. General obligation bonds are backed by tax revenues and must go through a competitive bidding process. Revenue bonds and corporate debt go through a negotiated underwriting process where the issuer and underwriter meet and come to mutually agreeable terms. Municipal securities are exempt securities. As such, no registration statement is filed with the SEC. Municipal securities are still regulated under the anti-fraud provisions of the Securities Exchange Act of 1934, subject to full and fair disclosure rules. For corporate issues, negotiated firm commitments are most common. In a negotiated firm commitment, the issuer and underwriter meet and come to mutually agreeable terms. Before a municipal new issue has been cleared for sale, a prospective customer may be given a preliminary official statement, but no money can change hands yet. Municipal advisors advise municipalities. Municipalities are local areas with their own government. Municipalities include states, cities, towns, and counties. Investors of 529 plans receive a program disclosure document. It is similar to a prospectus but prepared for a 529 plan. Regulation D is the federal private placement rule. Regulation D enables the issuer to make a private placement of securities without SEC registration. Regulation D allows for the legal sale of unregistered non-exempt securities. Under Regulation D, the shares may be offered to an unlimited number of accredited investors and up to 35 non-accredited investors. State law regarding private placements is stricter than federal law, allowing for only 10 offers in 12 months. The definition of accredited investor is found under Regulation D, Rule 251. There are 3 ways an individual can meet the definition of accredited investor: adjusted gross income, net worth, or by holding certain securities licenses. The AGI requirement, if single, is an adjusted gross income in excess of $200,000 in the previous 2 years and reasonably expected to be so this year, or in excess of $300,000 if married filing jointly. An accredited investor can qualify based on a net worth of greater than $1 million, excluding the value of their primary residence and any related debt. The net worth calculation can include assets of a spouse or spousal equivalent, as well as minor children, but not friends or adult children. An individual holding a Series 7, Series 65, or Series 82 license in good standing also qualifies as an accredited investor. Securities purchased in a Regulation D offering are restricted stock, shares that are not freely saleable. The sale of restricted stock is governed under SEC Rule 144 under Regulation D. SEC Rule 144 governs two types of stock: restricted stock and control stock. Restricted stock issued in a private placement by a reporting issuer must be held for 6 months before it may be sold. Restricted stock sold in a private placement by a non-reporting issuer must be held for 12 months before it can be sold. Control stock is stock that is held by a control person, sometimes referred to as an affiliate. Who owns the shares, not how they were acquired, is the determining factor for whether or not shares are considered control stock. A control person includes corporate directors, officers, large shareholders and their immediate family, and any person holding more than 10% of an issuer's outstanding shares. Purchases and sales of control stock that exceed the threshold must be reported to the SEC on Form 144 under Rule 144. When a control person will be placing an order to sell more than 5,000 shares or an aggregate sales price of greater than $50,000 in a 3-month period of time, Form 144 must be filed with the SEC prior to sale. There are volume limits related to how many shares of control stock may be sold in 90 days. The number of shares that an affiliate may sell during the 90-day period may not exceed the greater of 1% of the outstanding shares of the same class being sold, or, if the class is listed on a stock exchange, 1% of the average reported weekly trading volume during the 4 weeks preceding the filing of a notice of sale on Form 144. SEC Rule 144A sets forth the guidelines for the issuer when selling these shares of restricted stock to qualified institutional buyers. An issuer selling securities under Regulation D is required to file notice of sales on Form D with the SEC for each new offering of securities no later than 15 calendar days after the first sale of securities in the offering, unless the end of that period falls on a Saturday, Sunday, or holiday, in which case the due date would be the first business day following. Notice of sales on Form D is filed electronically through the EDGAR system, Electronic Data Gathering, Analysis, and Retrieval. The notice of sales on Form D must be signed by a person duly authorized by the issuer. In order to sell a new issue in more than one state, a registration statement must be filed with the SEC and with the state securities administrators. To register a security to be sold in a state is commonly called to blue sky the issue. Neither the SEC nor the state securities administrators approve any new issue. They will simply clear it for sale. A new issue that will be sold across state lines may be sold in a state when it is cleared for sale by the SEC. A prospectus must be given to all purchasers of a new issue under both state and federal securities laws. Exempt securities are exempt from registration and the filing of advertising materials. Exempt securities under the Securities Act of 1933 include municipal securities, U.S. government securities, securities issued by a recognized foreign government, securities issued by a federal, national, or state bank, securities issued by a nonprofit, religious, educational, or charitable organization, securities issued by public utilities and common carriers, commercial paper, bankers' acceptances, euro dollar bonds, and securities issued by Canadian municipalities. Non-exempt securities require registration. If a security is not listed as exempt, then it is non-exempt and must be registered. There are 3 types of registration under state securities laws, blue sky laws: registration by coordination, registration by notification, notice filing, and registration by qualification. Both registration by coordination and registration by filing are types of dual registration, with the securities being sold interstate across state lines. Registration by qualification is the type of registration that is used to register a securities offering that will be taking place in one state only. This is often called an intrastate offering. Under registration by qualification, the security may be sold in the state when the state securities administrator clears the issue for sale. SEC Rule 147 under the Securities Act of 1933 allows for a new issue that will be sold in one state only to be exempt from registration under federal law. Requirements of SEC Rule 147 include 100% of the purchasers must be residents of the state in which the securities are registered. 80% of the company's revenue must be produced in the state, and 80% of the proceeds from the new issue must be used in the state. During the first 6 months after issue, securities purchased under Rule 147 can only be sold to residents of that state. After 6 months, the security is freely saleable across state lines.